China finds itself at a crossroads. The nation's once booming property market teeters on the brink, raising fears of a full-blown economic crisis. The International Monetary Fund, recognizing the global danger, proposed a $1 trillion bailout, an unprecedented sum designed to stabilize China's struggling real estate sector. However, in a move that surprised many, Beijing flatly rejected the offer. This decision signals China's determination to find its own path out of the crisis, even as the world watches with bated breath. The roots of this crisis lie in the very foundation of China's economic miracle. For years, the country experienced unprecedented growth, transforming its cities and infrastructure at a breakneck pace. For decades, real estate has been the engine of growth, fueling investment, consumption, and even local government revenue. The construction boom led to the rapid urbanization of many regions, creating jobs and boosting the economy. Yet this dependence has come at a cost. The relentless drive to build more and more has led to a glut of properties, many of which now stand empty and unused. A culture of speculation and overbuilding has inflated property prices to unsustainable levels, creating a bubble ripe for bursting. Investors, both domestic and international, poured money into the market, hoping for high returns. The warning signs have been flashing for some time. Analysts and experts have been cautioning about the potential risks, but the momentum of growth seemed unstoppable. Major developers, burdened by colossal debts, have begun to default. These defaults have sent shockwaves through the market, causing panic among investors and homeowners alike. Construction projects have ground to a halt, leaving a trail of unfinished apartments and anxious home buyers in their wake. Many people who invested their life savings into these properties are now left in limbo. The fear now is that this contagion will spread, infecting the broader financial system and dragging down the entire Chinese economy. The interconnectedness of the real estate sector with other industries means that the ripple effects could be far-reaching.
The fear now is that this contagion will spread, causing a domino effect that could impact global markets, infecting the broader financial system, leading to tighter credit conditions and reduced consumer spending, and dragging down the entire Chinese economy. The repercussions of this crisis could reshape the global economic landscape, highlighting the vulnerabilities of over-reliance on real estate for growth.
China's rejection of the IMF bailout is not a sign of denial, but rather a calculated gamble. The decision reflects a deep understanding of the complexities and potential repercussions involved in accepting such a bailout. Beijing is acutely aware of the risks posed by the housing crisis, but fears the consequences of a massive bailout. The government understands that a large-scale intervention could lead to unintended consequences, such as inflating the bubble even further or creating dependency on external financial support.
Such a move, they argue, would only serve to delay the inevitable reckoning. Economists believe that postponing the problem could result in an even more severe economic downturn in the future, making the situation harder to manage, and could even exacerbate the problem by encouraging further moral hazard. This moral hazard could lead to reckless financial behavior, as businesses and individuals might expect future bailouts, reducing their incentive to act prudently. Instead, the Chinese government is opting for a more measured approach. This strategy involves carefully balancing the need to stabilize the market with the necessity of avoiding long-term dependency on government support. Targeted interventions designed to support struggling developers and restore confidence in the market are being deployed. These interventions include financial assistance to key developers, regulatory adjustments, and measures to boost consumer confidence in the housing sector. These measures are unlikely to provide a quick fix, but they reflect Beijing's belief that a gradual, controlled deflation of the bubble is preferable to a sudden and catastrophic collapse. The government is committed to a long-term strategy that aims to ensure sustainable growth and stability in the housing market, even if it means enduring short-term pain.
The IMF, however, remains unconvinced. In its latest assessment of the Chinese economy, the fund warned of the growing risks of deflation, a sustained period of falling prices that can cripple economic activity. This deflationary spiral could lead to a significant slowdown in economic growth, affecting not just China, but the global economy as well. The IMF's concerns are rooted in the potential for a prolonged period of economic stagnation, which could have far-reaching consequences. A deflating housing market could have a devastating ripple effect, hitting consumer spending, business investment, and ultimately global growth. The housing sector, being a major component of China's economy, plays a crucial role in maintaining economic stability. If housing prices continue to fall, it could lead to a loss of wealth for homeowners, reduced consumer confidence, and a decrease in spending. This, in turn, would affect businesses, leading to lower investments and potentially higher unemployment rates.
The IMF's prescription is clear. China must act decisively and swiftly. Delays, they argue, will only make the inevitable adjustment more painful. The fund emphasizes the importance of timely intervention to prevent a deeper economic crisis. They suggest that immediate action is necessary to stabilize the housing market and restore confidence among consumers and investors. The fund recommends a comprehensive package of reforms, including debt restructuring for struggling developers, increased fiscal support for vulnerable households, and structural reforms to reduce the economy's reliance on real estate. These measures are aimed at creating a more balanced and sustainable economic model. By addressing the root causes of the current economic challenges, the IMF believes that China can pave the way for long-term growth and stability.
Section 5. The global threat of deflation.
The stakes could not be higher, not just for China but for the world. A Chinese economic slump would send shockwaves through the global economy. Demand for commodities from oil to copper would plummet, impacting producers from Africa to Latin America. Global supply chains, already strained, would face further disruptions, and the specter of deflation, once confined to China, could easily spread to other major economies.
Section 6. China's tech pivot.
At the heart of China's strategy lies a fundamental bet that the future of its economy lies not in bricks and mortar, but in innovation and technology. Beijing has been actively fostering the growth of sectors like artificial intelligence, renewable energy, and electric vehicles, hoping to create new engines of growth. This pivot, however, will take time. Building a globally competitive tech sector is a long-term project, and it is unclear whether it can compensate for the short-term pain of a shrinking property market. The world is now watching to see if China can successfully navigate this delicate transition.
Section 7. A crisis of confidence.
Perhaps the greatest risk facing China is not economic, but psychological. The once unshakable confidence in the country's economic model has been dented. The government's ability to manage the economy, once taken for granted, is now being questioned. This loss of confidence is evident in the growing reluctance of Chinese households to spend and invest. It is visible in the outflow of capital from the country as investors seek safer havens. Until this confidence is restored, it will be difficult for China to achieve a sustainable recovery.
Section 8. What happens next? The coming months will be crucial for China. The world is watching closely to see how the government handles this crisis. Will Beijing stick to its guns and risk a deeper downturn? Or will it bow to pressure and unleash a wave of stimulus? The outcome of this crisis will have profound implications, not just for China, but for the global economy. One thing is certain. The era of China's easy, property-fueled growth is over. The question now is what will replace it. This is a pivotal moment in economic history. Stay informed.